Walmart Inc. stock is trading at $101.35 per share as of 11:57 a.m. EST on November 14, 2025, reflecting a decline of 1.18% in intraday trading. That dip of over a percentage point might lead the casual observer to believe the stock is simply caught up in broader market softness or feeling the pressure of pre-holiday jitters, especially with its next earnings report looming less than a week away. However, the unexpected insight lies not in the daily volatility, which is relatively muted for a retail giant of this scale, but in the recent quiet accumulation of shares by significant institutional players, despite the stock trading below its 15-day moving average and facing a slight pullback from its recent 52-week highs near $109. This suggests a disconnect between the near-term technical dip and the long-term positioning of sophisticated investors who are clearly looking past the immediate noise and betting heavily on Walmart's ability to weather macroeconomic headwinds better than most of its peers, especially heading into the crucial holiday shopping season. The general market expectation for Walmart right now is one of cautious optimism, grounded in the belief that its immense scale and focus on groceries, which account for roughly 60% of its U.S. revenue, make it a defensive play in an inflationary environment. The common narrative is that as consumers feel the pinch of higher prices, they will trade down from mid-tier retailers to value leaders like Walmart, essentially creating a flight-to-value effect. While this is true on the surface, the deeper reality challenging this simple expectation is that the recent stock performance and the smart institutional interest is less about grocery dominance and far more about the growth of its high-margin ancillary businesses, specifically its e-commerce platform, its third-party marketplace, and the rapidly scaling advertising division, Walmart Connect. The true value proposition for the stock isn't just its defensive grocery moat, but the successful execution of an aggressive digital transformation that is fundamentally shifting its revenue mix toward higher profitability. When we look at the last reported quarter, global e-commerce sales surged by 27%, with advertising business growth coming in even hotter, which is an incredible feat for a company of Walmart's size and completely changes the profile from a slow-growth consumer staple to a tech-enabled retail platform. This is the contrarian take that forces a rethink. The stock is being valued not just on its physical store strength, but increasingly on its digital capability, placing it in a different comparative category than just the Kroger Co. or Target Corp. Delving into the specifics of recent stock movement, the decline today and over the past month needs to be contextualized. Walmart stock has retreated about 4.36% over the last 30 days, primarily from profit-taking after a significant run-up that saw it touch its 52-week high in October. The trading volume, currently over 11 million shares, is respectable, but not indicative of panic selling. The key data point here is the institutional activity. Recent filings show a net increase in institutional positions, with major players like Vanguard Group Inc., BlackRock Inc., and JP Morgan Chase & Co. either increasing their stakes or maintaining massive long positions. For example, JP Morgan Chase & Co. notably increased their position by a sizable percentage in the last reported quarter. This accumulation, even as the stock consolidates, suggests a collective belief that the recent performance is not a cyclical fluke, but a structural shift. The immediate pressure point for the stock is the upcoming third-quarter earnings release, scheduled for November 20th. Analysts are anticipating year-over-year growth in both earnings per share and revenue, a forecast that has been recently revised slightly higher, indicating a bullish tilt right before the report. The expectation here is crucial. A beat will reinforce the flight-to-value narrative, but an outsized performance in the e-commerce and advertising segments will confirm the higher margin growth story, which is what the big funds are paying a premium for. Any individual brokerage or smaller investor who is relying only on the headline price-to-earnings ratio, which currently sits at 38 to 40, may think the stock is richly valued. But that view fails to account for the substantial and accelerating cash flow from its digital services and membership programs like Walmart Plus. The fundamental engine driving all of this is, of course, the underlying business model, which has always been about high-volume, low-margin retailing, the classic everyday low-price strategy. However, Walmart is not resting on its laurels. It operates in three core reportable segments: Walmart US, Walmart International, and Sam's Club US. Walmart US is the anchor, focusing on the core mass merchandising, including general merchandise and groceries, and importantly, integrating its vast store footprint with its digital platform for services like pickup and delivery. Walmart International brings diversification, with major operations in countries like Mexico, Canada, and China, where its e-commerce properties, like Flipkart, are dominant forces. Sam's Club provides a different, high-margin revenue stream through its membership fees. This traditional model is being overlaid with a very sophisticated technology play. The key is omni-channel integration, where physical stores act not just as sales points, but as micro-fulfillment centers, giving it a substantial competitive advantage in last-mile logistics over pure-play e-tailers. In the broader sector momentum, Walmart continues to gain market share in groceries, especially from middle and higher-income households drawn to value. This is a significant point. It's not just capturing the most price-sensitive consumers, but trading up, which strengthens its overall customer lifetime value. Furthermore, the growth of Walmart Connect, its advertising platform, is a direct, high-margin counterbalance to the thin margin in grocery. Companies are willing to pay a premium to advertise to Walmart's massive, purchase intent-driven customer base, much like they would on Amazon. This subtle but profound shift from purely product-based revenue to product plus service revenue is what institutional investors are genuinely excited about. The future outlook for Walmart stock centers on three main catalysts and two primary risks. The first catalyst is the continued acceleration of the digital services division. If Walmart Connect and Walmart Plus membership growth, which saw impressive membership income growth in previous reports, exceeds expectations, the market will re-rate the stock as a platform company, not just a retailer. The second catalyst is the successful integration of technology, particularly robotics and supply chain optimization, to manage rising wage and labor costs. Walmart's long history of operational efficiency suggests a high likelihood of success here. The third is the next earnings report on November 20th. A substantial beat, particularly on the e-commerce and margin front, could easily propel the stock back towards and potentially beyond its 52-week high, validating the institutional bullishness. Conversely, the risks are clear. Firstly, prolonged deep deflation in grocery prices could pressure the top line significantly, as it accounts for such a large portion of sales even if unit volumes remain high. Secondly, a misstep in international markets, particularly in complex regions, could drag on consolidated results. The company has a diverse business structure, but every international market presents unique economic and regulatory challenges. The performance of its retail peers, including Costco Wholesale Corp and Amazon.com, sets a high bar, and any failure to keep pace with the continued digital advancements of Amazon in particular would be a major disappointment. For those who are actively managing their holdings through self-investing platforms or an individual brokerage, trying to determine the correct asset allocation, the growth trajectory of Walmart's digital arms should be the primary consideration. It's an easy inclusion in an intelligent portfolio built for stability and moderate growth, given its sheer size and defensive qualities. But the real upside lies in the tech story. This deep look at the stock movement and business transformation brings us back to the tension between expectation and reality. The expectation is that Walmart is a boring, stable, but slow-growth retail stock, suitable only for the consumer staples basket of a conservative investor utilizing a tool like Schwab Intelligent Portfolios or just beginning their online investment with Fidelity or SoFi Invest. The reality is that Walmart is fundamentally transforming into a technology-enabled services and platform company, using its massive physical presence as an asset to gain an edge in a world dominated by online investing and digital commerce. The accumulation by institutional funds, even during short-term pullbacks, is the strongest signal that this deeper, more profitable reality is being priced in. It's a compelling case for a blue-chip stock with surprising digital velocity. I want to know what your portfolio looks like right now as you consider this stock. So, comment below with what percentage of your total investment is currently allocated to traditional retail stocks versus e-commerce or tech platforms. That real-world